Tyler spent 1,000 hours chasing stock tips and star funds and ended up $40,000 poorer than Bella, who did absolutely nothing after setting up one index fund. Bella bought one S&P 500 index fund in 2016. She set up automatic contributions, never looked at it again, and went on with her life. Both put in $500 a month, same time horizon, same market. Bella's account is ahead by tens of thousands of dollars, just by doing less. This is the index funds versus stocks versus actively managed funds breakdown. What each one actually is, why the data is so one-sided, and why Warren Buffett, the greatest stock picker alive, tells most people not to pick stocks. An individual stock is ownership in one specific company. Buy Apple, you own a piece of Apple. If it goes up, you win. If it collapses, you lose everything in that position. Your entire return depends on your ability to pick the right company at the right time. An index fund tracks a market index, most commonly the S&P 500, the 500 largest publicly traded companies in the United States. Buy an S&P 500 index fund, and you instantly own a tiny piece of all 500. Your return matches the index. No research, no picking, no guessing. An ETF, exchange traded fund, is just the packaging. It trades like a stock throughout the day on an exchange. VOO-SPY and IVV are all ETFs that hold the S&P 500 index. You can buy one share with no minimum, no wait, no paperwork beyond opening a brokerage account. A mutual fund holds the same thing an ETF might hold, but only prices, once daily at market close, and often requires a minimum to open. The ETF versus mutual funds versus index funds versus stocks confusion mostly comes from this. They can all hold the same underlying assets. Vanguard's S&P 500 ETF, VOO, and their S&P 500 mutual fund hold essentially the same assets. The ETF is just easier to access for most people starting out. The real choice isn't about the type of fund. It's about whether you're trying to outsmart the market or simply own it. The S&P 500 index has returned an average of about 10% annually over its history. According to Fidelity, the long-term average through recent decades is in the low double digits. In years like 2023, 2024, and 2025, the index delivered exceptional returns, 3 consecutive years of standout performance. Those are the numbers Bella's index fund was matching, automatically, passively, without Tyler's weekends of research. Tyler was trying to beat those numbers. And this is where the data becomes one of the most important things anyone who invests needs to understand. According to the SPIVA report, S&P indices versus active, only about 14% of actively managed large-cap U.S. equity funds beat the S&P 500 over the past 10 years. That means roughly 86% of professional fund managers, people who do this full-time, with teams of analysts and Bloomberg terminals and decades of experience, could not beat the index fund that Bella set up in 20 minutes. Over 15 years, it gets worse. Over the 15-year period ending recently, there was not a single category in which the majority of active managers outperformed their benchmark. Not one. And when those pros do beat the market in a given year, the persistent scorecard shows almost none of them can repeat it. Among top-performing active funds in one period, almost none remained in the top group just a few years later. If the professionals cannot beat it consistently, Tyler cannot beat it consistently either. This is not pessimism, it is the data. People hear that Warren Buffett is the greatest stock picker in history, and think that means they should pick stocks too. Buffett himself disagrees. In 2007, he made a public bet, $500,000, that a simple S&P 500 index fund would beat a professionally managed portfolio of hedge funds over 10 years. The hedge funds had the best managers in the world, sophisticated strategies, and every advantage money can buy. The S&P 500 index fund returned well over 100% over those 10 years. The hedge funds returned a fraction of that. Buffett won by a huge margin. His actual advice on record multiple times, is that after he dies, the money set aside for his wife should go into a simple S&P 500 index fund. Not his own stock picks, not Berkshire Hathaway, an index fund. The man who is the exception to the rule is explicitly telling you not to try to be the exception to the rule. Most people who pick stocks do not actually sit in a zero-cost brokerage account forever. They bounce between hot funds, managed accounts, and advisor strategies that quietly charge real money every year. Tyler's actively managed strategy, a mix of stock-picking funds and managed accounts, charges about 1% per year in fees. That sounds small. It is not. Bella's Index ETF, VOO, charges just 0.03%. On $10,000, she pays about $3 a year. Tyler? He pays $100. That $97 difference sounds trivial, but it compounds. Over 30 years, at a 10% return, that fee difference alone cost Tyler over $207,000. Same market, same contributions, but $200,000 less at retirement, just because of fees. And that's before we account for his stock picks underperforming. The $40,000 gap Tyler sees today, that's just the opening act. Every dollar that goes to fees is a dollar that could have been earning 10% returns for the next 20 years. The fee is stealing from future you. For most people building long-term wealth, a broad stock market index fund or an S&P 500 index fund held as an ETF at a low-cost brokerage. 3 funds cover almost anything you need. VOO, Vanguard S&P 500 ETF. Expense ratio 0.03%. Tracks the 500 largest US companies. The go-to for index funds for beginners and long-term investors alike. One share gets you in. IVV, iShares Core S&P 500 ETF. Expense ratio 0.03%. Essentially identical to VOO. Hundreds of billions of dollars in assets. FXAIX, Fidelity 500 Index Fund. A mutual fund, not an ETF, but expense ratio around 0.015%, even lower than VOO. If your account is at Fidelity, this answers what index fund should I invest in for most people starting out. All 3 track the same index. The tiny fee differences between them matter far less than the decision to own one of them in the first place. Individual stocks make sense in 2 situations, and neither is I have a feeling about this company. If you have genuine edge, deep expertise in a specific industry, real understanding of a company's competitive position, and the time to research continuously, index funds versus individual stocks becomes a real conversation. Individual stocks can complement a core index fund portfolio when you genuinely know more than the market does about a specific area. Most people do not have this. Most people think they do. The honest test: can you beat 86% of professional analysts who do this full time? If the answer is not a confident yes, backed by years of documented outperformance, the index fund wins. Individual stocks also make sense for small amounts when you're learning how markets work. As long as you understand those dollars are tuition, not an investment strategy. What you want to avoid is Tyler's situation, spending significant time on stock and fund research, paying higher fees, taking on more risk, and ending up with less money than if you had set up automatic contributions to an index fund and gone on with your life. That is what Bella did in 2016. 20 minutes, automatic contributions to an S&P 500 index ETF. Never read an earnings report, never tracked a stock, never touched it. And Tyler, who gave up 1,000 hours, paid higher fees, and took on more volatility, has less to show for it. The data is not close. The math is not close. The only question is whether you are willing to stop doing more and trust that less actually wins. Drop a comment. Team index fund, or do you pick individual stocks? This is not financial or investment advice. Past performance does not guarantee future results. Talk to a licensed financial professional for advice specific to your situation. Subscribe for more videos on how money actually works and how to make it work for you. See you next time.